By 2026, most top economists are forecasting that mortgage rates will ease. But the big question is, what does that actually mean for you? It leaves you with $1 million decision. Should you wait for that drop, or should you buy a house now and just plan to refinance later? Making the wrong choice here could literally cost you tens of thousands of dollars. It's a huge decision. And with so-called experts seemingly changing their minds every week, it's easy to feel lost. In this video, we're going to break down the official forecast from the biggest names in housing: Fannie Mae, the National Association of Realtors, and the Mortgage Bankers Association. And we're going to run the actual numbers. We'll look at the case for waiting versus the case for buying now, so you can walk away with a clear strategy that fits your situation. Let's be honest, the last few years have been financial whiplash for anyone trying to buy a home. We went from the unbelievable once-in-a-lifetime mortgage rates of early 2021 down around a record low of 2.65% to a brutal and rapid climb. To fight raging inflation, the Federal Reserve hiked its benchmark rate, which, along with other market forces like Treasury yields, sent mortgage rates soaring past 8% in October of 2023, a level we hadn't seen in over 2 decades. It was a shock to the system. Now, as we stand here at the end of 2025, things have cooled off a bit. After a few strategic cuts from the Fed, the average 30-year fixed rate is hovering in the low to mid 6% range, around 6.2 to 6.3%. And this is where the confusion really sets in. On one hand, a 6.3% rate feels astronomically high compared to the 3% world we just left behind. But if you look at the data going back to 1971, the historical average for a 30-year fixed mortgage is actually much higher, somewhere in the neighborhood of 7.7%. So we're caught in this weird middle ground. Rates are better than the recent terrifying peaks, but they're still double what they were just a few years ago. This creates the ultimate dilemma. Is this a moment of relief and a good time to act, or is it just a pause before rates get even better? That uncertainty is exactly what we're going to tackle. Let's start by looking at the argument for just waiting it out. The argument for waiting is simple and incredibly tempting. It's all about the potential for savings. The consensus among most major housing authorities is that mortgage rates will continue their gradual slide into 2026. Fannie Mae, for instance, predicts rates could end up around 5.9% by the end of 2026. The National Association of Realtors, NAR, and the Mortgage Bankers Association, MBA, see rates stabilizing somewhere between 6% and 6.4%. The driving forces behind this are cooling inflation, a softening labor market, and the expectation that the Federal Reserve will continue to gently cut its benchmark rate. So what does this actually mean for your wallet? Let's run a quick case study. Imagine you're looking at a $400,000 home. If you buy that home today, at the end of 2025, with a 30-year fixed rate of 6.3%, your monthly principal and interest payment would be approximately $2,475. Now, let's say you decide to wait. You hold off for a year and the forecasts are right. By the end of 2026, you're able to secure a rate of 5.75% on that same $400,000 home. Your new monthly principal and interest payment would be about $2,335. That's a saving of $140 every single month. Over the course of a year, that's almost $1,700 back in your pocket. And over the full 30-year term of the loan, you would save over $50,000 in total interest payments. When you see numbers like that, the argument for waiting sounds pretty compelling. It's a direct and measurable saving. On top of that, in a calmer market, you might face a little less competition, giving you more breathing room to think and negotiate. Now let's flip the coin, because this is where the math gets really interesting and where waiting can become a very costly mistake. The biggest risk you take when you wait for lower rates is that home prices do not wait with you. While you're on the sidelines hoping for rates to drop, the value of the very house you want to buy is likely rising. Forecasts from organizations like Realtor.com project that national home prices will rise modestly in 2026 by about 2.2%. Zillow's projections are in a similar range, forecasting a rise of around 1.2% to 1.5%. That might not sound like a lot, but let's run the numbers again. Let's go back to that same $400,000 home. You decide to wait a year for rates to drop. During that time, let's use the Realtor.com forecast, and the home's value increases by 2.2%. The new price of that home is now $408,800. You succeed in getting that lower mortgage rate of 5.75%. But now you're borrowing more money. Your new monthly principal and interest payment on the more expensive home would be approximately $2,387. Let's compare. Your payment if you had bought a year earlier at the higher 6.3% rate was $2,475. Your payment after waiting is now $2,387. The monthly saving is shrunk from $140 down to just $88. You've waited a whole year hoping to save big, only to see most of those savings eaten up by the home's appreciation. You paid nearly $9,000 more for the exact same house, and you lost a full year of building your own equity, paying rent to your landlord instead. And that's not even the biggest risk. The second, and arguably more stressful risk, is competition. What do you think happens the moment mortgage rates officially dip into the fives? It's a real possibility that every buyer who has been sitting on the sidelines for the last 2 years could jump back into the market. That could create a flood of demand. Suddenly, you're not just looking at homes, you're fighting for them. Bidding wars could return. Buyers might start waiving inspections and appraisal contingencies just to have a chance. The negotiating power you have today in a calmer market could completely evaporate. This is why you hear so many experts talking about the strategy. Marry the house, date the rate. The idea is simple. You focus on finding the right home for your life and your needs today. You lock in the price of the asset before it appreciates further and before the market gets flooded with competition. You accept a mortgage rate that you can comfortably afford right now, knowing it's not permanent. Then, when rates do eventually drop in 2026 or 2027, you simply refinance your loan to that lower rate and get a lower monthly payment. You get the best of both worlds. You secured the house you love at today's price, and you still get to benefit from lower rates in the future. It's easy to get tunnel vision on just rates and prices, but there are bigger economic forces at play. Mortgage rates don't move in a vacuum. They are heavily influenced by inflation and the bond market, specifically the yield on the 10-year Treasury note. The Federal Reserve's actions get all the headlines, but their decisions influence long-term mortgage rates more indirectly. What this means is that all of these 2026 forecasts are just educated guesses based on the data we have today. A single, stubborn inflation report could cause the Fed to delay rate cuts, keeping mortgage rates higher than predicted. An unexpected geopolitical event or a sudden change in the job market could also shift the landscape dramatically. This volatility is precisely why trying to perfectly time the market is so difficult and often a losing game. We have a solid consensus from experts, but there are no guarantees. This uncertainty actually strengthens the argument against waiting for a perfect moment that may never arrive. A strategy based on your personal readiness is always more reliable than one based on market speculation. So after all this, what's the final verdict? Should you buy now or wait? The truth is, there is no single answer that is right for everyone. The best decision for you depends entirely on where you are in your own financial life. So let's break it down by a few common buyer profiles. First, let's talk about the ready buyer. This is someone who has their financial house in order. You have a stable income, you've diligently saved a down payment, and you found a home that you love and can comfortably afford, even with today's mortgage rates in the low sixes. For you, the buy now and refinance later strategy is incredibly powerful. You get to stop paying rent, you lock in the home's price before it can rise further, and you start building equity immediately. You completely avoid the risk of being trampled in the bidding wars that could come when rates fall. For the ready buyer, acting now is a strategic move that positions you for a future win. Next, there's the stretched buyer. This is someone whose budget is already stretched thin. Maybe you have the down payment, but making the monthly mortgage payment at today's rates would leave you with very little financial breathing room. For you, being patient might be the more prudent path. Rushing into a home you can't truly afford is a recipe for stress and financial hardship. The wiser move is to use the next year to strengthen your financial position. Continue saving aggressively, pay down other debts, and look for ways to increase your income. The risk, of course, is that home prices could rise and you might be priced out. But that risk is often better than the certainty of becoming house poor. Finally, let's talk about the refinancer. This is someone who already owns a home and has a mortgage rate from the peak, say anything over 7%. For you, the decision is clear. With current rates hovering in the low sixes, you should be actively running the numbers on a refinance today. Don't wait for the absolute bottom. Refinancing now could potentially save you hundreds of dollars a month. A significant number of homeowners, with some analyses suggesting nearly 20% as of mid-2025, have a rate above 6% and are eager to lower their payments. Trying to time the housing market is a game of chance, but timing your own life is a strategy. What truly leads to success is having a clear plan, not trying to guess the market's every move. The decision to buy a home isn't just about numbers on a spreadsheet. It's about finding stability, building a future, and making a choice that aligns with your personal and financial goals. So now I want to hear from you. What's your plan? Are you team buy now or team wait? Let me know your strategy and your reasoning in the comments below. And if you found this breakdown helpful and want to stay ahead of the game on the 2026 housing market, make sure you subscribe and hit that notification bell. We'll keep you updated. Thanks for watching.